In 1912, Ludwig von Mises published a book that changed economics forever. He explained with mathematical precision why money must have certain characteristics to function in a free society. He wrote about scarcity, verifiability, divisibility, and most crucially, why money must emerge from voluntary exchange, never government force. He had no idea that 97 years later, someone using a fake name would create exactly what he described. Here's what's astonishing. Satoshi Nakamoto probably never read Mises. The Bitcoin white paper doesn't cite human action or the theory of money and credit. Yet Bitcoin's design mirrors, almost perfectly, every monetary principle Mises spent his career explaining. Think about that for a moment. An Austrian economist in 1912 Vienna describes the theoretical requirements for sound money. A cryptographer in 2009 creates a digital system. They never communicate. Different centuries, different purposes, different knowledge bases. And yet they arrive at identical conclusions. You know what this means? Either it's the most extraordinary coincidence in economic history, or Mises discovered something true, something so fundamentally true about how human beings cooperate and exchange that it manifests regardless of technology, regardless of intention, regardless of whether anyone's even trying to prove it. Your government prints trillions. Your savings lose purchasing power annually. Financial experts tell you inflation is transitory, while your grocery bill proves otherwise. Meanwhile, this weird internet money that shouldn't work, according to every mainstream economist, just passed its 16th year of continuous operation, processed over $10 trillion in transactions, and is being adopted by nation-states. What if the reason Bitcoin works isn't mysterious at all? What if Mises already explained it before computers, before the internet, before digital anything, because he understood something permanent about human action and economic calculation? You're not alone in feeling confused by Bitcoin. The confusion isn't about technology. It's because you've been taught wrong theories about what money actually is. Once you understand Mises, Bitcoin becomes obvious. And once you understand both, you'll never look at your dollars the same way again. I know you've heard 1,000 takes on Bitcoin. Financial advisors call it a scam. Tech bros call it the future. Economists call it a bubble. Everyone has an opinion. Nobody has a framework. Here's what this episode will give you. Not another opinion about Bitcoin's price, but a systematic framework for understanding money itself. One that predicts Bitcoin's characteristics, explains its success, and arms you with the clarity to evaluate any monetary system, from the dollar to gold to whatever comes next. Ludwig von Mises spent his life studying how societies coordinate economic activity. His insights about money weren't guesses. They were logical proofs derived from the nature of human action itself. And Bitcoin is the case study that validates every single one. If you want to discover how the greatest economic minds saw through government monetary manipulation and what that means for your financial future, subscribe to this channel where we explore thinkers who understood human nature before it was digitized. Before we can understand why Bitcoin proves Mises right, you need to know exactly what he said, not vague principles, precise, testable claims about money's nature and origin. Mises made a radical argument in 1912 that made him enemies for life. Money cannot and must not be created by government decree. Every attempt to create fiat money, money declared valuable by political authority rather than market process, eventually fails. Not sometimes, always. Why? Here's where Mises' logic becomes devastating. Money, he explained, doesn't start as money. It starts as a commodity people already value for other reasons. Gold for jewelry, silver for utensils, salt for preservation. Through countless individual decisions, people discover that certain commodities work better for indirect exchange. You want shoes but have wheat. The shoemaker wants tools, not wheat. So you trade wheat for something the shoemaker will accept. Gradually, spontaneously, one commodity emerges as the most marketable. This is a regression theorem. Money must have had non-monetary value before becoming money. Otherwise, the first person receiving it would ask, "Why should I accept this?" There'd be no answer. You see the problem with government paper money? It starts with political decree. This is money because we say so. But Mises proved mathematically that won't work long-term. Without market-based origin, without commodity foundation, fiat money rests entirely on confidence in issuing authority. And here's what governments always do with that authority. They inflate, they print, they debase, because the temptation is irresistible. Fund wars by votes, hide fiscal irresponsibility. Mises watched it happen in Austria after World War I. Hyperinflation destroyed his country's middle class. Notice what Mises is saying. The problem isn't too much money printing or irresponsible central bankers. The problem is structurally inevitable. Give government monopoly power over money, and inflation follows with mathematical certainty. Not because politicians are evil, because incentives are misaligned. Now here's the beautiful part of Mises's framework. He also explained what characteristics sound money must have. Not opinions, logical requirements derived from money's function in economic calculation. First, scarcity. If supply can be arbitrarily increased, it fails as a store of value. People won't hold it long-term because it loses purchasing power. Second, verifiability. You must be able to authenticate it easily. Otherwise, transaction costs explode. Every exchange requires expensive verification. Third, divisibility. You need to make change for different size transactions. Indivisible money limits market exchanges. Fourth, durability. It must survive storage and transfer without degrading. Perishable money fails. Fifth, portability. Moving it across space can't be prohibitively expensive. Immovable money limits trade geography. Wait, you're thinking, gold has all those features. Exactly. That's why gold emerged as money across cultures and centuries through market process, not government mandate. Mises wasn't inventing requirements. He was observing what worked. But here's what probably fascinates you most. Mises also explained why money must resist political manipulation. He called this the economic calculation problem. Entrepreneurs need accurate price signals to allocate resources efficiently. When government manipulates money supply, price signals become distorted. Businesses can't tell if rising prices mean genuine demand or just monetary inflation. They misallocate resources, boom and bust cycles follow inevitably. Sound money for Mises isn't a nice-to-have. It's the foundation of rational economic calculation, which is a foundation of prosperity itself. So when Mises surveyed monetary history, he saw a pattern. Societies prosper under sound money. Gold standard periods collapse under debased money. Every fiat experiment eventually fails. Not correlation, causation. Remember all this, because in 2009, someone created something that has every single characteristic Mises described, while avoiding every pitfall he warned against. And they probably did it by accident. Let's now examine the problem that led to Bitcoin's creation. January 3rd, 2009. Satoshi Nakamoto mines the first Bitcoin block. Embedded in that block, he includes a headline from that day's London Times: Chancellor on brink of second bailout for banks. Think about that choice. He's launching a new monetary system. His founding message references government rescuing failed banks with printed money. What problem do you think he's trying to solve? Here's the fascinating part. Satoshi's white paper is 9 pages of technical cryptography. It never mentions Austrian economics. It doesn't cite Mises or Hayek. It focuses on solving a narrow computer science problem. How do we create digital scarcity without a trusted central authority? But look at what that question implies. Digital scarcity, recognition that money must be scarce. Without trusted central authority, recognition that centralized control creates systemic risk. Satoshi observed what you've observed. Every digital system requires someone in charge. Your bank balance? Bank controls it. Can freeze it. Can inflate it through fractional reserves. Can lock you out. PayPal? Same thing. Venmo? Zelle? Credit cards? Every digital payment system has a central point of control, which means a central point of failure and a central point of manipulation. The cypherpunk community, cryptographers who value privacy and decentralization, had tried creating digital cash for decades. DigiCash in the 1990s, e-gold in the 2000s. Every attempt failed because they required trusted third parties. The company running DigiCash went bankrupt. The operators of e-gold got arrested. Centralized digital money, they learned painfully, just recreates the problems of bank money with new technology. So Satoshi made a logical deduction that Mises would have appreciated. If centralized control is a problem, we need decentralized money. Money that belongs to no one and everyone simultaneously. Money that operates by mathematical rules, not human discretion. But here's the engineering challenge that stumped everyone before Bitcoin. How do you prevent double spending in a decentralized system? With physical cash, I give you a dollar bill, I no longer have it. Problem solved. With digital files, I can copy them infinitely. Send you the same digital dollar I send someone else. Without a central authority tracking who owns what, digital money seemed impossible. Satoshi's breakthrough combined several existing technologies in a novel way. Cryptographic hashing, distributed ledgers, proof-of-work consensus. The details are technical, but the principle is simple. Instead of one trusted authority maintaining the ledger who owns what, thousands of independent nodes maintain identical copies. They compete to validate transactions through computational work. Attempting to cheat requires overpowering the majority of the network. Economically irrational because the cost exceeds potential gain. Look at what he created through this design. A monetary system where supply is mathematically fixed, 21 million Bitcoin maximum, where ownership is cryptographically verifiable, where units are infinitely divisible down to 100 million of a Bitcoin, where the ledger is permanent and auditable, where transfer costs are minimal relative to value moved, and where no authority can arbitrarily inflate supply or confiscate holdings. You know what that list is? It's Mises' requirements for sound money, implemented in code. Satoshi probably thought he was just solving a computer science puzzle. But he accidentally created what Mises described theoretically. Money that emerges from voluntary adoption rather than political decree, that maintains scarcity through mathematical rules rather than physical limits, that resists manipulation through decentralized consensus rather than institutional trust. And here's the really wild part. Bitcoin violates Mises' regression theorem. Remember, money must originate as a commodity with non-monetary use value. Bitcoin had zero non-monetary value. It was just code. It shouldn't have worked according to strict Misesian theory, but it did work. Why? Because Mises wasn't quite complete in his analysis. His framework was right about government fiat money. That fails because political authority is arbitrary and subject to manipulation. But he lived before digital technology, so he couldn't imagine money whose rules are mathematical rather than political. Bitcoin didn't need commodity origin because its scarcity is provable through code. The first people who accepted it could verify. This system will never produce more than 21 million units. That verification replaced commodity history. Mises would have been fascinated by this development. It refines rather than refutes his framework. Now comes the real test. Theory is one thing, reality is another. Mises insisted economic principles must manifest in history, not just logic. So what happened when Bitcoin met the real world? You know the mainstream story. Bitcoin was for criminals. Silk Road, money laundering, scam, bubble, tulip mania. I can create infinite cryptocurrencies, therefore none have value. That's what Nobel Prize-winning economists said. Paul Krugman called it a bubble wrapped in techno-mysticism inside a cocoon of libertarian ideology. Strong language from very smart people. And yet, Bitcoin didn't care about their opinions. Because markets don't care about credentials. Markets care about reality. Let's trace what actually happened. 2009, Bitcoin worth nothing. Literally zero. Satoshi mines blocks. A few cryptographers play with the code. 2010, first real-world transaction. 10,000 Bitcoin for 2 pizzas. Price discovery begins. 2011, Bitcoin reaches $1, then $31, then crashes to $2. Critics declare it dead. But here's what Mises taught about market-selected money. It emerges gradually, first as curiosity, then speculation, then medium of exchange, finally store of value. Each stage tests whether it fulfills monetary functions better than alternatives. Bitcoin followed this exact pattern. Early adopters, cryptographers who understood the technology. Why did they value it? Not for pizza, for the principle of permissionless digital cash. That's non-monetary value in a different form than gold jewelry. It's value for the optionality of censorship-resistant transactions. Notice a Misesian insight. Bitcoin didn't start as money. It started as useful technology. The progression to money followed market process, not government decree. 2013, Cyprus banking crisis. Government confiscates depositor funds to bail out banks. Bitcoin surges as people seek alternatives to confiscatable bank deposits. Mises' prediction validated. When political money reveals its true nature, people flee to alternatives. 2017, Bitcoin reached $20,000. Massive speculation, obvious bubble. Crashes to $3,000 in 2018. Critics again declare it dead, this time for sure. But again, what does Mises teach about market processes? Prices overshoot. Bubbles occur. That's not dysfunction, that's discovery. Entrepreneurs test business models. Most fail, survivors adapt. Each Bitcoin boom-bust cycle shakes out weak hands, strengthens infrastructure, teaches lessons. And here's the crucial observation. After every crash, the bottom gets higher. 2011 drops to $2. 2015 drops to $200. 2018 drops to $3,000. 2022 drops to $16,000. Wait, you're thinking that's not a dying asset. That's adoption volatility. Exactly. Mises would recognize this immediately. Early adoption of superior technology is volatile precisely because it's superior. Remember when internet stocks crashed in 2000? Did that mean the internet was a scam? No, it meant pricing discovery is messy. The internet was real. The business models needed refinement. If Bitcoin's 16-year survival despite constant obituaries makes you question mainstream economic narratives, hit like so more people discover how markets actually work versus how textbooks claim they work. Meanwhile, what happened to government currencies during Bitcoin's lifetime? U.S. money supply increased 400%. Interest rates went to zero, then negative in Europe. Central banks bought their own government debt, literally printing money to fund deficits. Venezuela, Zimbabwe, Turkey, Argentina, hyperinflation destroyed savings. And Bitcoin, it chugged along. Every 10 minutes, new block, every block, transactions validated, every validation, proof that decentralized consensus works. Through government bans in China, multiple times, through infrastructure attacks, through exchange hacks, through coordinated media campaigns against it, the system worked. Not perfectly. Transaction fees spiked during peak usage. Scaling remains challenging, but the core monetary properties held. No one inflated supply. No one confiscated Bitcoin from the network, only from exchanges, trusted third parties, the very thing Bitcoin was designed to eliminate. No one stopped person-to-person transfers. Mises observed that sound money survives crisis, while political money fails. That's not prophecy, it's pattern recognition. And Bitcoin's 16-year stress test validated the pattern with digital precision. 2025, Bitcoin's market cap exceeds $1 trillion. Nation-states hold it as reserve asset. Major corporations hold it on balance sheets. Millions of ordinary people, including maybe you, hold some as insurance against monetary chaos. That's not speculation anymore. That's adoption. And adoption proved utility. Market-tested, government-resistant, Mises-compatible utility. Here's where Bitcoin becomes more than just sound money. It becomes proof of Mises's most important insight. Economic calculation requires undistorted price signals. Remember Mises's argument against central planning? Socialists said, "We'll calculate economic needs centrally and distribute resources rationally." Mises proved mathematically that that's impossible. Why? Because without market prices emerging from voluntary exchange, you have no way to determine value. Is aluminum better used for airplanes or soda cans? In a market, prices tell you. High demand for airplanes raises aluminum prices. Soda makers substitute plastic. In central planning, some bureaucrat guesses and gets it wrong and creates shortages and blames saboteurs. The same logic applies to money. When government manipulates money supply, price signals become distorted. Business sees rising prices. Is that genuine demand or monetary inflation? Should they expand production, or is this artificial boom that'll bust? They can't tell, so they miscalculate. Austrian business cycle theory, derived directly from this insight, explains boom-bust patterns that Keynesian economics can't explain. Now watch what Bitcoin does to this problem. Bitcoin's supply schedule is public, certain, and unchangeable. Every participant knows exactly how much exists and exactly how much will exist at any future date. There's no Federal Reserve meeting to guess about, no political pressure to print for stimulus, no surprise inflation. This creates what Mises called calculational stability. When the monetary unit itself is predictable, prices can accurately reflect underlying supply and demand for goods and services. The money isn't adding noise to the signal. You experience this distortion right now with dollars. You see your rent increase 30% in 3 years. Is that because housing demand increased? Because building restrictions limited supply? Because your city became more desirable? Or because the Fed printed 40% more dollars? Probably all the above, but you can't isolate which factor matters most. That's calculational chaos. You can't make rational economic decisions when the measuring stick itself is changing. Bitcoin fixes this. Not perfectly. Its price in dollar terms is volatile because we're measuring a stable unit against an unstable unit. But Bitcoin to Bitcoin value is calculationally stable. 1 Bitcoin always equals 1 Bitcoin. When services start pricing in Bitcoin terms, you could actually see undistorted price signals. This matters more than you might think. Mises explained that civilization itself depends on economic calculation. Division of labor requires people to specialize. Specialization requires trade. Trade requires prices. Prices require stable money. Break the money, you break the entire chain. Why do you think totalitarian regimes always control money? It's not just about funding themselves. It's about controlling economic calculation. When government monopolizes money creation and manipulates supply, it can direct resources through inflation, fund favored industries with cheap credit, punish disfavored ones by restricting it. That's not paranoia. That's how Chinese social credit systems work. It's how Canadian government froze trucker protesters' bank accounts. It's how the US government uses banking regulations to debank politically incorrect businesses. Bitcoin represents something more threatening to political control than you might realize. It's uncensorable economic calculation. You can't stop Bitcoin transactions without shutting down the internet globally. You can't inflate Bitcoin supply with political pressure. You can't freeze someone's self-custody Bitcoin. This is why authoritarian governments ban it and democratic governments try to regulate it. Not because it's used for crime. Cash is used for far more crime. But because it removes monetary control from political authority. And here's the Misesian insight that makes this profound. Economic freedom and political freedom are inseparable. Control money. Control everything else eventually. Free money. Free everything else eventually. Bitcoin is a 16-year experiment in whether Mises was right that decentralized economic calculation outperforms centralized manipulation. The fact that Bitcoin still exists, that it processed trillions in transactions, that it survived nation-state hostility, that it attracted voluntary adoption by millions, is empirical validation. Mises spent his career arguing that market processes generate information that central planning cannot replicate. Bitcoin is that argument implemented in code. Every block is proof. Every transaction is evidence. Every year of survival is vindication. You don't have to worship Bitcoin to recognize what it proves about Mises' framework. He was right about money's nature, right about political manipulation's inevitability, right about market processes' superiority, right about economic calculations' requirements. The code doesn't lie. The blockchain doesn't spin. The mathematics doesn't compromise. And 16 years of data doesn't care about academic credentials or political preferences. Let's bring this home to your life. Why does it matter that Bitcoin validates Mises? Because understanding this framework transforms how you see everything financial. Right now, you probably think about money in conventional terms. Dollars are real money. Bitcoin is alternative or speculative. This framing is backward. Here's what Mises teaches. Dollars are the experiment. Since 1971, when Nixon ended dollar-gold convertibility, the entire world had been running an unprecedented experiment in purely fiat money. No commodity, no convertibility. Just trust in government's restraint. 54 years. That's the experiment's duration. And what are the results? The dollar lost 87% of its purchasing power. Real wages stagnated despite productivity gains. Wealth inequality exploded as those closest to money creation, finance, real estate, government contractors, captured most gains. Boom-bust cycles became more severe. Debt reached mathematically unsustainable levels. $34 trillion federal debt, 120% of GDP. That's not success. That's a slow-motion collapse Mises predicted in the 1920s. He explained that fiat money creates illusion of prosperity through artificial booms. But eventually mathematics catches up. You can't print wealth. You can only redistribute through inflation from savers to debtors, from fixed income to asset owners, from powerless to powerful. Bitcoin, by contrast, is 16 years of demonstrated sound money principles. Fixed supply, decentralized verification, transparent rules, no political manipulation, and it's appreciating against every fiat currency, not because Bitcoin is gaining value, but because fiat currencies are losing it. Think about what this means practically. Your financial advisor probably tells you to hold 60% stocks, 40% bonds. Why? Because that's optimal in a world where currency itself is reliable. But what if currency reliability is the illusion? Mises would say, first secure sound money, then invest. If your monetary foundation is rotting, inflating, your entire portfolio is built on quicksand. This is why wealthy families historically held gold, not for returns, but for preservation. Bitcoin offers what gold offered, monetary hardness. But with advantages gold lacks: digital transferability, perfect verifiability, programmable divisibility. It's not digital gold as metaphor. It's Mises' monetary principles implemented more purely than gold itself. Because gold could be debased, governments shave coins concentrated, governments confiscate, as FDR did in 1933 and restricted, governments banned private ownership. Bitcoin can't be debased, mathematics prevents it. Can't be confiscated from self-custody. Cryptography prevents it. Can't be banned effectively. Decentralization prevents it. Now, I'm not telling you what to do financially. That's not what understanding Mises provides. But he gives you a framework for evaluation. Ask yourself, does this money maintain scarcity? Bitcoin, yes. Dollars, no. Does it resist political manipulation? Bitcoin, yes. Dollars, no. Does it enable economic calculation? Bitcoin, yes, increasingly. Dollars, no, decreasingly. Does it preserve purchasing power? Bitcoin volatile, but trending up, dollars certain down. You start seeing clearly. Bitcoin's volatility isn't a bug, it's adoption price discovery. Dollar stability is the illusion, slow, consistent debasement masked by CPI manipulation and global reserve currency status. When you understand Mises, you recognize that the safe asset, dollars and savings account, losing 3 to 8% annually to real inflation, is actually the risky bet on government restraint and mathematical impossibility. While the risky asset, Bitcoin, volatile but strictly scarce, is actually the bet on mathematics and market process, the bet Mises would make. This isn't about getting rich quick. It's about protecting what you've already earned from systematic theft through inflation. It's about opting out a monetary system Mises proved must eventually fail. It's about teaching your kids principles that will outlive current political arrangements. Because here's what history teaches. Every fiat currency eventually fails. Not most, all. The only question is timing. Rome debased silver denarius until empire collapsed. Revolutionary France printed assignats until hyperinflation. Weimar Germany printed marks until middle class was destroyed. Every modern fiat currency has lost 90% plus purchasing power within living memory. The dollar will be no exception. Not because I say so, because mathematics says so. The debt can't be repaid, so it will be inflated away. Your savings will be collateral damage unless you understand what Mises understood. Sound money is the foundation of everything else. Bitcoin proves he was right. The question is whether you'll recognize what that proof means before the lesson becomes much more expensive. You started this episode maybe curious about Bitcoin, maybe skeptical, maybe already holding some but unsure why. Now you see the deeper pattern. Ludwig von Mises spent his career explaining economic laws that politicians hated and academics ignored. He proved that money creation causes inflation, that central planning fails through calculational impossibility, that sound money requires market process, not political decree. He lived through hyperinflation. He fled the Nazis. He watched socialism destroy nations. He spent 40 years teaching at NYU, largely dismissed by mainstream economists who found Keynesian equations more politically useful than Austrian logic. And then, 9 years after his death, a pseudonymous programmer created a system that validates every monetary principle Mises articulated, not intentionally, probably accidentally, but the validation is undeniable. Bitcoin works because Mises was right about what money requires. It survives because Mises was right about market process. It appreciates because Mises was right about fiat currency's inevitable debasement. Every block mined is another proof. Every transaction is more evidence. Every year of continued operation, despite government hostility, is vindication. This is bigger than Bitcoin. This is about whether objective economic laws exist, laws as real as physics, as unavoidable as mathematics. Mainstream economics treats the economy like a machine government can tune and adjust. Mises treated it like an ecology of human choices, following logical patterns. Bitcoin's existence proves Mises right. You can't decree money into soundness any more than you can decree water to flow uphill. You can only create conditions where sound money emerges, or suppress those conditions and suffer consequences. The transformation this should create in you isn't go by Bitcoin. It's understand that economic truth is discovered, not constructed. Politicians can't repeal supply and demand any more than they can repeal gravity. Central banks can't create wealth any more than they can create energy from nothing. Mises knew this. Bitcoin demonstrates this. And now you know this. That knowledge changes everything about how you interpret financial news, evaluate political promises, protect your family prosperity, and understand the times you're living through. The emperor has no clothes. And once you see it, you can't unsee it. From now on, when politicians promise to stimulate the economy through spending, you'll remember what Mises taught and Bitcoin proved. You can't print prosperity. You can only redistribute it through inflation. When you see your grocery bill rising while officials claim inflation is under control, you'll understand you're watching Mises' predictions play out in real time. In coming months, observe the difference between how Bitcoin operates and how government money operates. Bitcoin, predictable issuance schedule, public verification, no emergency adjustments. Government money, surprise rate changes, secret banking rescues, perpetual extraordinary measures. Which system exhibits the characteristics Mises said sound money requires? You don't need to become a Bitcoin maximalist. You need to become a clear thinker about monetary reality. Ask yourself, if I had to preserve my wealth for my grandchildren, would I trust mathematical scarcity or political promises? Would I bet on decentralized verification or centralized discretion? When you doubt, and you will doubt, because this framework contradicts everything you were taught in school, remember this. Mises explained in 1912 what Bitcoin demonstrated in 2009 through 2025. That's not coincidence. That's discovery of truth. Your financial decisions should reflect reality, not wishful thinking. Bitcoin exists as option B precisely because option A, trust government money, has failed every time it's been tried throughout history. Mises documented this pattern. You're living through the next iteration. The question isn't whether fiat currencies will fail. Mises proved they must. The question is whether you'll recognize the pattern before or after your savings lose another 50% of purchasing power. Bitcoin offers you the chance to learn the lesson theoretically rather than catastrophically. That's what Mises would tell you. That's what Bitcoin is showing you. The choice is yours. There's a phrase from Mises I can't forget. Economics must not be relegated to classrooms and statistical offices, and must not be left to esoteric circles. It is a philosophy of human life and action, and concerns everybody and everything. It is the pith of civilization and of man's human existence. Do you feel the weight of that truth? Economics is an academic abstraction. It's the difference between prosperity and poverty, freedom and tyranny, your children inheriting opportunity or debt. And Bitcoin has transformed it from theory into code you can verify yourself. Imagine your life 6 months after truly grasping Misesian monetary principles. You won't be perfect. Mises never promised perfection. But you'll see through government spin with crystal clarity. You'll recognize inflation for what it is. Theft through debasement. You'll understand why stimulus creates boom-bust cycles. And when everyone around you panics about the next financial crisis, you'll know exactly what's happening and why. Because Mises explained it a century ago, and Bitcoin is demonstrated in real time. This channel exists to discover together the wisdom of thinkers like Ludwig von Mises, people who understood human nature and economic law before computers, before central banks' unlimited power, before anyone imagined digital scarcity, but whose principles remain as true today as when first articulated. Subscribe if you want to continue this journey of discovering timeless truth in contemporary chaos. In the next video, we'll explore another Misesian insight that explains why government intervention always makes problems worse, and what that means for every regulation, subsidy, and solution politicians propose. See you there. And meanwhile, may you see clearly what others choose to ignore.